Hi, this is Toni Hansen, and I want to thank you for joining me today for my presentation, Unleash Your Winning Trades. In this video, I'm going to share with you 3 powerful strategies that I use for timing my winning trades and keeping me in those winning trades longer. Now, I've been trading for, more than 15 years now, and over those years, there have been a lot of hurdles that I've had to overcome in my own trading. And I think, though, that none of them was more frustrating than finding myself in a winning strategy, but then walking away with maybe the same amount that I had risked on the trade in the first place. So instead of getting 3, 4, 5 times what I was risking on a trade, I would walk away lucky to have covered my stop on the position. And of course, if you're looking at a long-term career in trading, this is not exactly the right path to be on. You have to be successful substantially more than 50% of the time if you want to walk away with getting one-to-one risk to reward on your trade. There are a lot of strategies out there where if you just use the basic concepts for those strategies, you can get 2-to-1 on the trade 80% of the time. So if you risk $100 on a trade, 80% of the time, you're going to walk away with $200 on the trade. That is, if your timing is accurate and if you have the ability and the confidence to hold for those gains. Almost from the very beginning of my trading career, I started sharing with other traders. I began what was basically the precursor of a blog at the time, and on it I would post what I was looking for strategies. Not only, what are the symbols, what are the trades that I'm looking for, but what are the reasons behind the trades? Why am I entering a position? What am I looking at for a target level? And that really helps me progress as a trader. I began to understand, well, here are some of the things that I can use to give me the confidence to hold for those target levels that I was already seeing had a high probability of hitting, and I just was not holding to get those levels. So what I was posting as my goals on a trade weren't what I was actually seeing in my account. But I needed something that would push me to that next level, that would help me hold on to those winning positions and develop the confidence to do so. So in today's class, that's what I want to focus on. I'm going to begin today's class with something that a lot of people skip over. They kind of push through, rush through this disclaimer page, but I really do want to emphasize that as a trader, there's always a risk involved. Even if you have a strategy that you've developed over years that you know when executed properly is going to be successful 80% of the time, that does not mean that you cannot get hit with some very large losses, particularly if unexpected news comes out or you have some sort of system failure. Who knows? There's always a risk involved though, and it is very important that you don't just gloss it over and overlook that potential. So as we proceed, take it seriously and do whatever you can to mitigate your risk, but know that it's still always going to be there. That being said, I can teach anyone. Now, this is not a phrase that I came up with. This is the phrase that my art instructor in high school shared with me when I first walked into class. He said, I can teach anyone to become an artist. I've heard this statement over and over again over the years, but it was something that you don't always take seriously. And before I was a trader, I was educated as an artist. I grew up in the arts. My dad, he was one of those people that was actually disappointed that I did not continue to pursue art after graduation. But I think that it works incredibly well in the field of finance, particularly in the field of technical analysis. Over the years, I learned a lot of different strategies for recognizing patterns that were taking place, not just in nature, but in everything. And these really carried over extremely well into understanding the markets and reading not only charts, but just understanding market psychology and market behavior. I think perhaps one of the most fascinating things is a lot of people take for granted that you have to have some sort of innate ability to become an artist, that people are born an artist or they're not. And the reality is that you can really teach anybody the art of analysis. You can teach them to draw. You can teach them to become a better artist. This is an example, there are so many art classes out there these days, but this is just an example from a 5-day seminar, and it shows a before and after picture of one of the classmates, and this was just a very typical example of what his drawing looked like at the beginning of the class. When he first came in, they did, okay, do your self-portrait. What does your self-portrait look like? And the image on the left is what he drew for his portrait. After 5 days, however, after the instructor shared with him, many of the techniques that he used to become a better artist, the result is what you see there on the right. So this is somebody that really did not have a strong background in the arts, but after 5 days, just learning some core techniques, look at the result. How many of you guys can say that if you pick up a pen, pick up a pencil? How accurate of a portrait are you going to be able to draw of yourself? Now, if we take that a step farther, this is another class, and this is a bit longer. You're looking at something over 21 weeks. But once again, look at the image over there on the left. That is her self-portrait. And 21 weeks later, look at what you're seeing over there on the right. Now, I might not want to take somebody seriously when they can tell me I can teach anybody to become an artist. But the fact is, I've seen it. I've seen it over and over and over again. I've seen it not only in the field of art, but I've seen it in the field of finance as well. There have actually been studies and challenges where brokerage firms have taken people off of the street and taught them over the course of a couple of months to become a technical analyst for the firm. And amazingly, they found that really like 80% of the people were able to become a pretty decent technical analyst over that, over the course of that period. So when I'm hearing the stories of people coming into trading and saying, Toni, wow, you must really have an eye for this. It's not that I was miraculously born with the ability to read the markets and the ability to be a good trader. It was something that I had to work at, but I learned a lot of techniques for developing that ability in the first place. One of the things that was always hard for me as an artist is that I'm a perfectionist. I always struggled to want to be better, to do better, and not being able to get the complete gains that I was seeing out of a trade was really, really difficult to try to overcome. It was one of those things where I thought about quitting. I thought, well, maybe I'm not cut out to do this. Maybe I can't make it. But I thought back to those art classes, and I thought back to a lot of what I learned there. And I think one of the most important things that I learned was that I didn't have to be perfect to be good. I didn't have to nail every single high as I was, long a position. I didn't have to get every single cent out of a position. But there were techniques that I could use that would help me become better, that would help me get closer to that goal. And over time, I learned more and more of those techniques. So, there are many times now that, I do a lot of live trading classes, and I will show them literally exits and entries in a position where you cannot time it better. I'll get an exit that it's like a tick or two off of the high. And it's really just putting into practice the techniques that I've learned over the years. So in today's class, I'm just going to show you a couple of very simple ones. You don't have to get into really advanced technical analysis to improve your trading. So I'm going to just share with you some of those simple techniques that I use that I think is really going to help you hold on to those positions to get more out of them. Interestingly, I'm going to take you back to the world of art. Now, from a very young age, I was familiar with who Leonardo da Vinci was, and he was revered as one of the greatest artists of all time. And towards the beginning of my career as a trader, I had the opportunity to visit the Louvre, and I remember they had an exhibition there that focused on Da Vinci's drawings and his studies of structure and anatomy. And part of that exhibition had a focus on Fibonacci. Da Vinci was incredibly fond of Fibonacci and the techniques and the concepts behind Fibonacci, and he used them quite often throughout his works. Unarguably, one of Da Vinci's most famous works is the Mona Lisa. Now, there's a little bit of a debate as to whether or not Da Vinci actually used Fibonacci in the painting of the Mona Lisa, but what we do know is that he used it in many of his other works, and those that have studied the Mona Lisa have seen the Fibonacci ratios and the aspects carried out throughout this painting. And what is fascinating is that the concept of Fibonacci carries not just through the world of art, but to many other mediums as well. And the medium of finance is one of the areas that Fibonacci gets the greatest attention. It's very hard to not run into the term Fibonacci these days. This is something that popular culture has been obsessed with for years. But outside of the art world, there's no place that you're going to see this obsession put to a bigger test than when it comes to trading. Because Fibonacci is one of those things that even a newbie trader is going to run across at some point or another. Just to give you a little bit of a basic background on the concept of Fibonacci. Fibonacci is a mathematical sequence, and in it, you're basically just taking the sum of the previous two numbers. So in a Fibonacci sequence, you're looking at the sum of 1 plus 2 leads to 3, 2 plus 3 is 5, 3 plus 5 is 8, and so on and so forth. The man attributed to bringing Fibonacci to the Western world is Leonardo Pisano, and his nickname was actually Fibonacci, and this is how we get the name that we use today. In finance, the way that we use Fibonacci has to do with what are called the Fibonacci ratios. One of the most famous is called the golden ratio or divine proportion, and this is what you see a lot of times throughout the art world. Basically, it occurs when you divide something into two parts so that the larger part divided by the smaller part is also equal to the whole divided by the larger part. Then you have that golden ratio or divine proportion. When we look at this ratio as an example using numbers, you're going to see that if you take any two numbers that equal 100, such as 61.77 plus 38.33, you can also take those numbers and divide them, and you're going to end up with 1.618. The golden ratio or the divine proportion occurs when 100 divided by that first number also equals 1.618. So 100 divided by 61.77 is going to lead to that 1.618 ratio. And that is the aspect ratio that you can see here on the face of the Mona Lisa, where the forehead is 1, but the rest of the face is the 1.618. What makes Fibonacci so fascinating to people is that there's an obsession with symmetry and what is beauty in nature. People have tried to apply Fibonacci to many different things, sometimes successfully, sometimes unsuccessfully. But in the world of finance, what I found very quickly on is that this is one of those places where Fibonacci really does stand out, and it can definitely be used to help you not only with timing your entry on a trade, but also projecting where those target levels are going to be on a position. And if you know where those projected levels are and you have a reason behind them being there in the first place, it helps you build the confidence that you can have to hold to those levels. So one of the first techniques that we're going to look at to get you to that point is how to time your trade. So we're going to use Fibonacci as an additional tool to give you confidence in your market timing. One of my favorite strategies has to do with continuation patterns. So I'm looking for periods of congestion that are taking place in the market, such as where you might see two waves of correction off of a high, and this leads to a trading range. Well, when you're looking at that correction developing, one of the key levels of support that you're going to run into is one of those Fibonacci ratios. In this case, the first one that I'm going to share with you is 38.2%. The 38.2% Fibonacci level comes from a ratio that is found by dividing any number in the Fibonacci sequence by the number that is found two places to the right. So, for example, if you take 38 divided by 89, that's going to yield approximately 0.382. And when you translate this into percentage, you have that 38.2% level. When we're looking at this on the charts, if you're looking at a move from a low to a high, such as the low here on the US Canadian dollar pair, to the move here, then that 38.2% retracement level is going to be a major level of support for the security before it attempts to do a continuation move. So if we get that two-wave correction or two-wave pullback, again, this is one of my favorite strategies for continuation. If we see that hold, that 38.2% level, that gives it that extra strength for an upside breakout. So instead of waiting for a break of the highs from the entire trading channel, I will watch for that pullback into that 38.2% level and look for a reversal strategy on a smaller time frame coming off of that support zone. So instead of taking an entry trigger up here, for example, my trigger is down here coming off of that Fibonacci support level. And this is going to give you a much higher probability trade where when you can time your entry properly and you can get as close to that support level as possible, you have a greater potential for return than you would if you were taking a larger breakout of that entire channel. Now, it can be a little confusing how to draw these Fibonacci levels on your charts. So I'm going to switch over to my charts here really quick and show you what that looks like. Now here's the chart of the US Canadian dollar pair as we see it on my trading platform. So if we are going to add those retracement levels, what you want to do is you look under your drawing tool, pull up the price retracement lines, and then in adding those retracement levels, you want to look at what is the major price move that you're comparing. In this case, we're going to be looking at the extension levels for this move on the upside. So we're seeing originally a low here, extending that point upwards, and now this projects those retracement points onto our chart. Here's another base where we have a run and then we have a pullback. Once again, it has come back into that 38.2% retracement level. If we scroll over a little bit farther, we have a couple of other corrective moves. Here's an initial drop to the downside with a downtrend, and we have a retracement point of 61.8%. And we're going to look at this level a little bit more here in just a few minutes. But first, let's go look at the next point for the next drop. And notice once again how well it pulls up into that zone of the 38.2% retracement. So over and over again, we are seeing these Fibonacci retracement levels hold incredibly well and leading to continuations of a larger trend. Here's another example of that two-wave continuation strategy. However, this time we're looking at it on the short side. And it's not leading to a larger momentum continuation, but we are still seeing a very strong strategy develop. And what is interesting about this one is that it also combines a second pattern that is one of my favorite strategies. So we have a two-wave bounce from here to here is the first one, right up into that 38.2% Fibonacci retracement level, pulls back down near the lows, and then we see that secondary bounce. With this secondary bounce, however, we're seeing a momentum shift. So you're getting a slower move the second time around into that 38.2% level. So the second pattern is one that I call a momentum reversal. And it is a very, very strong pattern for looking at a pivot type of trade. And when I'm trading it, instead of taking a channel break, such as the lower end here, oftentimes I am taking it off of the upper end of that channel. So when you combine that with something like this 38.2% Fibonacci retracement level, you have some incredibly powerful forces behind you on that trade. And even though this didn't make it to substantially lower lows, we still saw a very strong move back to the lower end of this trading range. Another Fibonacci ratio level that is very powerful is the 23.6% retracement. This is one that is not used as often as the 38.2, but it also works very, very well. Now this ratio is found by dividing any number in the Fibonacci sequence by the number that is 3 places to the right. So our 38.2 is 2 places to the right. This is 3 places to the right. So for example, 55 divided by 233 is approximately 0.2361, or our 23.6% retracement. We're going to switch back here to a trade we were looking at earlier. I was in this position originally from this two-wave continuation pattern over here, taking this break here, but I was looking for a place that I could add to the position. I really liked what was going on the larger time frames, and I thought, you know what, we still have the potential for another upside move. So what I wanted to see was, where can I identify a major support level to add to this position? In this case, that 23.6% Fibonacci retracement served incredibly well. We had a two-wave pullback off of that first high, which interestingly is the negative 23.6% retracement point. But we had that pullback here to that Fibonacci level. It's also right smack in the middle of all of this congestion, meaning that not only did we have Fibonacci support here, but we also had other types of price support that were playing a role in a bounce at this point. So I used that level to add to that position. Now, the first technique we looked at had to do with using Fibonacci for timing those winning positions, for getting into them at levels that you might not have otherwise considered entering the trade. But the second technique that we're going to look at is how to use Fibonacci to establish a solid target level on a trade. I mentioned earlier, one of the most difficult things a trader runs into when trying to hold for those larger gains is breaking through the barrier that is really a barrier in your confidence level. You know, it's not that you don't understand that a trade has more potential to it. You already might have a strategy that you know has that larger potential. But it's a difference between knowing that it's there instinctively and understanding why it is there and having reasons behind holding to those larger levels. If you just know that a trade has an 80% chance of hitting twice what you are risking for your gain, that's one thing. But understanding where that level is that is going to stall the trade, where that zone is that you're going to get that result, that's another thing entirely. And if you have a system such as an indicator that can help place that point on the chart for you, it becomes easier to hold on to it. It's like that finish line. If you're a runner, seeing that finish line in the distance, having that goal to reach for is a lot different than just setting out and beginning a run. If you just begin to run randomly, no goal in mind, it's hard to say when to stop. Where do you go? How far do you go? But if you have a reason for looking at that target level, then it's a lot easier to hold for that target level. We've looked at a couple of different Fibonacci ratios so far that are very powerful in technical analysis, but there's another one that I want to introduce you to, and that is the 61.8% retracement and extension level. This key Fibonacci ratio is derived by dividing any number in the Fibonacci sequence by the number that immediately follows it. For example, 55 divided by 89 is approximately 0.618. And when you translate that into a percentage, you're dealing with the 61.8% retracement and extension level. To show you how to draw this on the chart, you go up to drawing, pick your price extension lines, take the low of the move to the high of the move, and then take it to that second low within the congestion point. So this gives us an extension point of 61.8% right here. Now, my larger target level on a trade is typically that 100% extension point. So I'll usually be looking at the 61.8% as an initial resistance level that I might run into part of the way there. But a lot of times my larger goal is that 100% point. Sometimes, however, things happen that affect how that trade works out. And if you're looking at trying to hold on to the trade to get more out of it, one of the ways that you can do that is first identify where these closer target levels are, these closer resistance points are, such as the 61.8% extension. And use that as a level where you can take and protect part of your position. So when this is coming into the 61.8% zone, that becomes a good place to take off, let's say, half of your trade to begin with. And then hold the rest looking for that larger target level. Let's say you have a strategy such as this. This is this two-wave breakout strategy that I love, and typically it's going to hit that 100% extension point. So whenever I am entering into this particular trade, I'm looking at that 100% level as my target zone. Sometimes things unfold, however, and it might not get there. It might hold a closer resistance level, such as the 61.8%. So what I'll do is, if I think there's that added risk that something could happen, might not get there, I'll go ahead and I'll take off part of my position at that resistance. As you gain confidence in a trade and you gain confidence in where those targets are going to hold, it becomes easier to hold a larger portion of your trade for those target levels. So for example, if you're working on hitting those larger targets, one of the first things you can do is take off that part of the trade at that initial resistance point using these Fibonacci levels to target those resistance points. And then hold through a correction. Be willing to say, okay, the rest of the position, I'm going to be willing to take a stop on it unless it hits my goal. Having taken off part of the trade already, most I'm going to really worry about is maybe a scratched trade. But it gives me that portion that I can hold on to, that I can start to build confidence in my strategy. I already know from back testing or from demo trading that it has a great propensity for hitting that target level. Now the point is how to get to that target level. Having these goals in mind, you can gradually back off how much you are holding at those first resistance points. So instead of taking off 50% of the trade, next time around you take off 25% of the trade. And one of the things that I had to do when I was pushing through to the next level in my trading was I would take off part of the trade there. I'd have a bracket order where my bracket order would automatically execute part of my trade as it was coming into that first resistance point. And I use these Fibonacci levels to help me give confirmation for where those resistance points were. And then I would leave the bracket order with a stop on the rest of the trade, but I would have the rest of the bracket order getting me out at that larger target level. On this strategy, for example, it's that 100% point. So leaving that on the books and just kind of walking away, distracting myself with something else, whether it was scanning through other markets, looking for other trades that might develop later on, or just getting up and taking a walk around the office or going out, walking around the block, or whatever. It gets you away from the computer. It gets you away from that intense focus where you can change that order that you have on your books. There are going to be reasons that you will want to change those orders, but when you're developing that confidence in the first place, it's important to just kind of do or die, as you might say. You're either going to get it all or you're going to get none of it. Once you have a firm grasp on using tools like Fibonacci, though, it becomes so much easier for understanding why those support and resistance levels are holding in the first place and holding to get to those target levels. Here's another example of that extension point holding as a firm support or resistance level. In this case, we're looking at it as support. What is interesting here is that this drop, this move lower here, retraced to the 38.2% Fibonacci retracement level that we were looking at earlier. It was that resistance zone that helped trigger this move for the continuation on the downside. And notice that it comes right into that 61.8% extension level. So once again, this is that first major extension level that serves incredibly well for continuation types of strategies. Now that I've shown you a core technique that you can use for timing your entry on some of these stronger trades and shown you one strategy for how to pinpoint target levels to help build that confidence that you need to hold on to those winning trades, the third thing that I want to share with you is how to reinforce those target points. Seeing one point of resistance or one point of support on a chart is one thing, but having that support level reinforced or having that resistance level reinforced, that can make a lot of difference in your confidence as well. Let's go back to this trade that we had in the US Canadian dollar, for example. We were looking at that breakout from the two-wave correction here, and it pulled higher into that 61.8% extension level, but notice that this also corresponds to a 23.6% retracement level. So we pointed this out a little bit earlier, but this is showing it here to you on the chart as well. So we now have two levels of Fibonacci that are coming together to indicate this as a strong resistance point. And what this helped me do was, as I added onto the position over here, building on the position that I already had taken from the initial breakout, it led me to protect my gains coming into this resistance point once again. I was originally expecting that larger 100% extension, but the trend changed, so my plan had to change with it. So I used that negative 23.6% retracement level and that 61.8% extension level to help take gains off at that zone. Here's the slide showing you that 61.8% zone right here. And you can also see a little bit of the follow through as well. When you add a bunch of Fibonacci levels to your chart, it creates these levels that are called Fibonacci clusters. And these are stronger support and resistance levels than you will find just looking at one type of Fibonacci. So when you have two or three Fibonacci levels all coming together at once, it's going to be an even greater reason to take part of your position off at that point. Another level that we have on this trade is looking at the drop heading into the evening, where we had that strong downside move prior to our move higher. Now the move higher retraced 50%, which isn't technically a Fibonacci level, but it is a Fibonacci point that you will find on your charts, even though it doesn't really correspond to the sequence at all. It's something that, psychologically, another reason to look at that as a support or resistance level. When we had the retracement here and then the break higher, you'll notice that it broke to that 61.8% retracement of the larger trend move on the downside. So, in addition to having the 61.8% extension point from the rally off of the lows and the negative 23.6% retracement point, we also have that 61.8% retracement from the larger trend move as well. It's very easy for your charts to become incredibly clustered if you just keep adding Fibonacci levels over and over and over again. But what you're going to find is that if you look at the larger trend moves, such as the drop here, if you keep those on your charts over time, those levels are going to continue to hold for days into the future, even if you're just looking at an intraday chart. What I like to do is make the Fibonacci levels very, very pale colors, really light grays, light pastels, so they sort of fade into the background. That way they're not really as overpowering as they would be if you use, the really bright, vibrant colors. Even, we have something sort of in between here right now. But if you use something that is a little bit less strong, then you're still going to be able to see those zones on your charts as you take future trades. And they're going to help you with identifying upcoming levels for support and resistance, as well as that target timing that you're going to be looking for. So as you start to see them not holding quite as well over time, then go ahead and erase those. But as long as you're seeing the major pivot points taking place off of the Fibonacci levels that you've drawn on your chart, continue to keep those on your charts into the future as well. I think the thing that was most unexpected to me, I guess you could say, when I was looking at applying Fibonacci to trading was, even though I was very familiar with it in the art world, I thought, how well is it really going to work in practice when I am putting it on my charts? Because if you look at Fibonacci ratios in the real world, in real world examples, there are a lot of things that receive hype in pop culture, but when you actually study them, you could say, well, that is maybe just a bit of a fluke. It doesn't really hold for every single occurrence, or maybe it doesn't even hold as strong as it would be suggested in the examples. And even with a lot of the painters and artists from several hundred years ago that used Fibonacci, even in many of their examples, people cannot say for certain that a lot of the paintings were necessarily based on Fibonacci, or musical compositions were necessarily using Fibonacci or incorporating Fibonacci, or if it was just sort of a coincidence that it happened to apply. But what is interesting is that if you add Fibonacci to your trading, it really does work incredibly well. Part of this, who knows, maybe it's a little bit of self-fulfillment. Maybe it's because so many people do use it, and so many of the major levels, such as the 38.2, are followed so strongly. It's interesting because Fibonacci works perhaps even better in the Forex markets and in the E-mini markets than it does in individual stocks. Well, we see it work very well in individual stocks. You can literally time pivot points in Forex trading based purely upon Fibonacci levels. So I have to admit, it was a little bit unexpected for me to see exactly how well it works. But as human beings, we like symmetry, we like patterns, we behave in predictable manners. Anytime you look at a chart, you are looking at human psychology as it plays out. And Fibonacci is just one of those extra things that helps identify and visualize what those psychological points are. Now that I've shared with you some of the techniques that I use for timing my entries, as well as placing my target levels and how to develop confidence in those target levels, the next thing is to develop an understanding for some of the dynamics that go into price development that create the reasons behind certain levels, such as that 61.8% that we were looking at, will hold in some cases, but the next time around, that same trade could go ahead and hit that 100% extension point. In the next video, I'm going to share with you some of the advanced techniques that I use for timing pivots, how to develop an understanding for why is it that 38.2% has a higher probability of holding in one instant, but in another, you're going to be looking more for a 61.2% retracement or even 100% retracement before you see a reaction. So join me for video number 2, Advanced Pivot Timing Techniques, and this will be a session that even if you're a newbie trader, I guarantee you're still going to be able to follow along. So take care, and I'll see you then.